What's up traders, Tom here with another video. Today we'll be discussing one of my favorite topics, what shares I'm looking at in the stock market right now. With long-term opportunities arising again for investors, let's dive right in and show you 10 stocks we are looking at. Stay tuned. In this video, we'll be taking a look at our broader thoughts on the stock market, as well as the top 10 stocks that we're looking at and the reasons that we make decisions behind these concepts. With certain metrics not making sense fundamentally, you have to think beyond that and you have to think over the next 10 years or 5 years when making investment decisions. Think about how governments make money. Think about how governments spend out of recessions. These are the thought processes that often go behind making decisions over time for a diversified portfolio. It's important to understand that the information contained in this video is going to be purely for educational purposes. The information provided will not take into account any of your specific needs or circumstances into consideration. And you must look at your own personal situation and requirements before making any financial decisions and seek independent financial advice always when necessary. Before we get started, I'd also like to remind everybody that if you've been enjoying our content or you like content like this, remember to subscribe and hit that bell. And if by the end of this video you do enjoy the content, make sure to give us a thumbs up as it helps us in the algorithm with YouTube to build the channel and build the community. Speaking of community, we have a free public Discord down below that you can access by clicking the links. And we also have a free trading cheat sheet if you're into that technical analysis. It has some of the best patterns to use when making informed decisions. So last week in the stock market, we saw a very large move, of course, a 6% down day. And usually that would be extreme, but with what the trading movements have been over the last couple of months, it seems like the norm nowadays. But there are some things that we need to think about when making decisions. Is this just a dip in the stock market with buying opportunities, or is there more to come? That really will be something that's times to tell. But we've talked about how the 2800 level and this level here were going to act as supports. So we'll see what happens next week, whether this second wave idea becomes more of a problem or whether Wall Street's just trying to steal some money from the new rise of the day trader on websites like Robinhood and others. With interest at all-time peaks in the stock market, I thought we'd cover some of our stocks that we're looking at. So the first stock we're going to look at today is Amazon. And it comes as no surprise that Amazon is on our list. It's on so many people's lists. And it's a very easy choice in terms of long-term prospects. Amazon can benefit from things like AI in the future, where they could potentially literally use robots for a lot of their workforce. And I'm sure that's a huge plan of theirs. That'll cut costs. And we also have a huge amount of distribution and people moving online due to this crisis. So Amazon has a wide business. There's so many things out there that make it advantageous, but we want to talk about a few things here. So one, analysts have been raising their expectations for Amazon over time. We have Wells Fargo, UBS, RBC, Merrill. So many companies have now gone over 3,000 for their next 12 months in terms of expectations for Amazon. When we're looking at Amazon though, we want to look at what's happened over time. So Amazon has had a massive run on it really since all the way back in start of the smartphones when we look at the share price. And it's been an amazing investment for many. With the movement over the last kind of 24 months, what we would want to see is we would really want to see Amazon probably return back to some form of median. I personally would be looking at levels around 2000, 2100, where the market would be coming back down and during that retest would be hitting previous resistances. Would I buy Amazon here? As a long term, it's always an opportunity, but the thing is, it's all about getting good levels, and Amazon's probably one of those ones that you would want to wait for before getting into. The next one is a beaten down stock, and that's Walt Disney. Now, has it been beaten that much? It's come up recently, but that's because of the strength in the business as a whole. Once we get past this current crisis, Walt Disney has so many great IPs and they have so much great businesses. If you could pick the worst possible scenario for Walt Disney, it would be this current crisis. It hits almost every one of their businesses and stalls so many of their pipeline ideas and things that they had ready to go. Disney, though, is so big that it will have the cash flow and it will have the funding to be able to easily survive And realistically, once the crisis is over, you will see things like Disney Plus and other services grow and expand over time. Pretty big fan of Disney. It's been a stock that I've always looked at and always thought it was a very good one. And it is already coming down again. On this chart, you'll notice it says the 12-month target's 120. But realistically, I think this stock is already trading at 115 and it could very easily get back to like the 100 or 110 kind of area. It may not go back to 80s, but it's pretty stable. Again, we look at it over history. We see that it had a big run from 2011 to 2015. It's been relatively stable since then, and they've added Fox and they've added so much. So I think Disney is a good long-term prospect and one that many people are looking at in their portfolios. The next one, I'm a bit of an avid gamer, so I'm a bit of a fan of Activision Blizzard. Activision owns Call of Duty. And of course, Blizzard is known for things like World of Warcraft, Diablo, StarCraft, and all of those types of franchises. Blizzard used to be the best company in gaming. If you follow gaming at all, they were number one and it wasn't even close. Quality, quality, quality. Every game they bought out had 5-10 years in it and people are cult following of Blizzard IPs. They have stumbled over the last couple of years. And if you actually look at their way that they're dealing with media and their audience, it has not been good. I think though, with the current crisis, people moving indoors and of course being scared probably for a decent amount of time moving forward, you will see gaming grow and grow and grow. And the great thing for Blizzard Activision is they have so many games in the pipeline. You're going to see new games come out, they move into mobile, and realistically, they have a great chance of having success. A lot of Blizzard's growth has come from things like Candy Crush Saga, which probably most people are aware of, and their normal IPs. But look at their growth since 2012. Of course, it made sense that the stock would have a bit of a sell-off. We're not back to all-time highs yet. And when it comes to Blizzard, you'd be probably looking at around that $60 to $63 to get back in if you were able to do so. Good long-term hold. Definitely a cool company, and I think they've got a lot of great games in the pipe, which they're going to make some pretty good money from. Next up, another tech stock. They're not all tech stocks, don't worry, and that's Google Alphabet. Now, this is the one tech stock in kind of the big boys that I would say is not performing well. And that just shows you on the charts how Google have not been able to come up with a new idea in a very long time. Google have tried things. I think it's Stadia, which is like an online gaming service. It's an absolute failure. That thing is terrible, and I'm sure it will not work. But Google have some great IPs. Obviously, they've got the search engine. They've got YouTube, which you're watching this video on now. They also have Android, and they've got a great kind of user base there. So I think Google still present decent opportunity. And when we look at them on the charts, we can see that they have not done that well for quite a long period of time. Like all of those other tech stocks, big run up since 2012 till around 2018, and then relatively stagnant since then with just that kind of normal consistent growth that you would expect. With this stock, if you could pick it up around 1200, it would be an interesting level. That would technically be a zone that you could look at. And I think Google has great long-term prospects. As soon as they potentially do an outright buyout or they make a breakthrough in AI or anything else, which they are leaders in, I think Google have decent long-term prospects, and they're more importantly at a more fair price than some of their competitors. Okay, so I'm accused a little bit by the Australians on this channel that I don't talk about Australian stock. So we'll talk about a bank, and that bank is the Commonwealth Bank of Australia. In fact, it's the largest stock in Australia. I don't think CSL have taken them out just yet. Now, Commonwealth Bank is well known in Australia, and for any Americans that are watching this channel, this will apply to them as well. Basically, the concept is that banks are beaten down stocks. Is the Commonwealth Bank the most beaten down bank out there? No, but there are reasons why I'm picking this one. It's always been well known, it's always had a very good broad business, and it specifically can take advantage of their big brand name. So most mums and dads and most people that invest in houses, they will usually like to have things with Commonwealth Bank just because Commonwealth Bank's the biggest and therefore the best. I was talking with a few people the other day, and we're talking about the idea of negative interest rates. Now, not obviously, negative interest rates are an absolutely terrible thing for banks. We saw that in Europe, and we do not want that in any other country, ideally, if you're a bank holder. So if we look at Commonwealth Bank over time, this is pretty much not really a great growth story. Obviously, it got beaten down during the GFC, came up and hit around $96 at the high. Are we still trading low? Yes, we are. Would I be getting into it here? You could if you wanted to long-term hold, but really it's that kind of pricing around that low 60s that you'd be looking at with Commonwealth Bank. And it did sell off relatively strongly into Friday. So it's about $67. Commonwealth Bank and any of the other big three banks, ANZ, Westpac, and NAB in Australia, are all great prospects in terms of dividends, franking credits for the long-term future. And we'll see how they deal with things. As long as interest rates don't go negative, I still think they have growth in them and they still have potential to maybe rechange some of their staffing. And because we had a Royal Bank inquiry, I think you'll find that they're overpaying on a lot of staff members that they can cut some of, let's call it, the fat from. And after this crisis, they will do restructuring. The same goes in the US. If you have quality banks that you're looking at, and you don't believe that they're going to go negative interest rates, while I don't think there'll be huge growth stories, there could be decent dividend long-term opportunities. And as I mentioned, 3 months out of a crisis, generally value performs better than growth. And that has been statistically proven over time. So Commonwealth Bank is next up on the list. Next one we have covered on the channel, and that is McDonald's. It has defensive-like properties and recession-like properties. So I think it's no surprise to anyone that we are in a weird trading environment where we're going to see high unemployment, but at the same time that we're seeing high unemployment, we potentially could be seeing all-time highs on the stock markets. If you're looking at a defensive property, McDonald's could be the one, because McDonald's was one of the only stocks to go up over the GFC. Unfortunately, the reason why that happens is people get generally depressed, and when people get depressed, they often eat junk food, and McDonald's directly benefits from that. Right now, McDonald's is actually getting hit because people aren't going to their jobs in the morning, and because of that, they're not buying the breakfast, they're not buying those, kind of things where they buy the coffee, they go through the drive-through and they spend more money there. But as the economies reopen, which they will over time, we're all sure of that, McDonald's could be that good defensive idea in the portfolio. McDonald's is trading about 189. Anywhere between that kind of 170 to 180 is definitely good buying for McDonald's. If we look at it over time, it's had a pretty good run on it, but it is a company that has a great brand name. It's doing well in Asia, and realistically, they will grow over time. They're a company that is almost not too big to fail, but they're definitely one of the leaders in the field, and they're hard to upset, especially with their brand name. Next one for Australians again, but this stock is on the American exchange, and it goes for all iron ore miners, and that is BHP. So BHP is basically the biggest miner in Australia. They own a whole bunch of different resources, including things like iron ore, coal, energy, gas, all of these things. So BHP have moved up recently. It's a shame I couldn't make a video earlier, as it was one of the ones that I was talking about 3 weeks ago, where I said that when businesses, or more importantly, when economies come out of a recession, usually governments like to build. And when they build, they need iron ore for their building and their construction purposes. So we've already seen a spike off the Brazilian issues with this current crisis. And that's because Vale has had to shut down some of their production, which has spiked iron ore across the board. Now, that's a little bit unfortunate if you're not already in iron ore, but iron ore is one of those ones that when you come out of recessions, generally it does very well. Let's have a quick look at the BHP chart over time and talk about where it's been. So BHP has moved quite sharply up and down, but it hasn't been a story of growth. It's been a story of trade and sell it at certain highs. So we saw recently that BHP was on the move to around $42 a share, and it's been as high as around 49 pre-GFC. Now with BHP, look at what happened out of the GFC. Look at the strong growth that we saw, and that was because of the demand in iron ore up until 2011, and then the crash in iron ore prices twice through 2011 to 2012 and 2014 down to 2016. So BHP has strong cash flow. It's readjusted its business. It has incredibly cheap iron ore production, and it's definitely one of those ones that you could be looking at. Along the same line for another Australian kind of buy, but again on the American Stock Exchange, is Rio. If you prefer just to own iron ore, Rio could be the one you're looking at. Rio is really strong in main minerals and metals, whereas BHP also has that kind of gas area to them as well. So Rio is a strong company. Again, is trading slightly higher than I'd hoped at this time. Well, unless you're in it, then it's okay. But that's because of the Vail stuff. And I'd say with Rio, you're basically looking at trying to get it in the high 80s, low 90s for longer term holds. With BHP, by the way, in terms of where you're trying to get that one, around 32 to 34 would be strong levels for sure. At least technically anyway. Okay, next one up, Coca-Cola. Well, Coca-Cola, very similar to McDonald's. It benefits during recessions often because people are unfortunately not that happy and they tend to move to junk foods, and Coke is certainly one of those popular ones. Coke's already been beaten down quite a lot and it's been moving aggressively down because as we see so many restaurants being closed, Coke and its distribution chains are not doing well. It's got great cash flow, okay dividend, I guess, and it's been a staple. Again, strong brand name, unlikely to be completely destroyed during any kind of crisis like this, and it's one of those ones that has a buy rating from the general kind of fundamental people. Where's Coke right now? We're trading about $45. Anywhere in the low 40s is very good buying. In terms of this, if we look at it over time, you will notice that Coke has kind of been pretty defensive and hasn't really moved too much. It's not really that strong growth stock, but if you get it at the right price, it can definitely be one to add to any portfolio really. So around those low 40s would be a good target for Coke. Last one, Mastercard. So Mastercard is possibly a little expensive right now. It's had some great earnings and it looks like people are still spending quite a lot online and they're using Mastercard. Mastercard has been a success story for sure in the stock markets. It will probably continue to be one for the foreseeable future with strong online sales and strong online purchases. People are using these kind of payment processing, and Mastercard has a buy from 36 analysts. Now their target's only $320. It has sold off and it's under $300 right now. And I think it's getting a little bit hot. So with Mastercard, it's one of those ones where if you could pick it up for cheaper rates, then of course it does make sense. $297 on the close, anywhere kind of around that $260 would be a technical level of support, which could be interesting for anybody to look at. I hope everyone's enjoyed this video today. If you have, make sure to subscribe and hit that bell for more content. I'd also like some questions down below with answers that you might want to know, as I'm thinking about doing a Q&A video a week to answer many people's questions about trading and also investing with our experience over time. Thanks everybody and happy trading. Bye.